Dear students, welcome you all to the 19th session of Personal Investment Management. So we are under the module 3 and we are going to discuss today in this session how to invest in stock market. So we have already discussed how to invest in stock market. This is the extension of that session. So in this session we are going to discuss what are the factors to be considered before investing in stock market. So let's directly go to the various factors that we have to consider or we have to take into account before we go for investing in the stock markets, because these are very important and we should understand the effect of these factors before we could invest in the shares. The first one is the time horizon. So time horizon means deciding the time period, because we can invest, we have different options in stock market. We can invest for short term market, or we can invest for medium term or long term, and all these time durations, time horizons have different benefits and we have to analyze these benefits. So what is time horizon? Deciding the time period of investment. As I told you, we can invest for short term, we can invest for medium term, and we can invest for long term. So short term means usually for the shorter period. It may be for day trading or 1 week or 1 month or less than 1 year. Long term usually it's more than 1 year, we say. So all these different terms have different benefits. So for example, if you go for short term, you can definitely reap the benefits of higher value in the shares, and whenever the share prices go up, you can sell it, and whenever the share prices comes down, we can buy it, and we can keep the same momentum going on. Whenever the shares go up, sell. Whenever the shares come down, we have to buy. Long-term horizon have its own benefits, because you need not worry about all the short-term market fluctuations or volatilities. You can keep quiet and, as Warren Buffett said, invest and forget. So that you can practice. Should take into account what Warren Buffett said. What he said, invest and forget. So this is the best uh, principle for long-term investment. Should not worry about the short-term fluctuations at all. You should just invest and forget. So after maybe a 1 year or 2 years, you have to just see the progress of your shares or the investments. That is regarding the time horizon. Next one is investment strategy. So what you want from the investment? Basically, there are different objectives. Some say I want regular returns, and some say I want the growth of my asset or asset value. Some say I want both. So, what is the purpose or goal of my investment? And that goal should be matched with the strategy. And we should choose a strategy either to grow your investment or get income regularly from the investment. So if you have to grow your investment, there are different set of shares that you should invest, usually in the maybe blue chip companies where there is definitely growth of your stock, or income investing where you want higher income, or maybe the companies which pay higher dividend, or you can choose debt instruments or anything. But this investment strategy should align with your financial goals. That's what I said. What is your financial goal? What do you want from the investment? Whether it is for long term, short term, first that you have to decide. And what is the purpose of your investment? Whether it is to grow your investment, grow your money, or regularly get income from the investment. And that should match. Based on that, we can definitely find a suitable strategy. And also we should understand the risk appetite, because risk appetite varies from person to person. I may not take more risk, or I may take more risk, but other person may not take that much of risk. So what is my risk appetite? Whether I'm a risk averse or risk neutral, or that I should understand first, and based on that I have to choose our investment strategy. Third one, fundamental analysis. I think I have already spoken about this in the previous session. regarding the fundamental analysis. Very, very important. The meaning itself says we have to analyze the fundamentals of a company on which you are going to invest. For example, I want to invest in MRF Company Limited. So before investing in MRF company, I should first know what is MRF company, in which sector it is operating, its past data, its past financial performance, its present financial statements, who are the directors, who is CEO, what is their beta, what is their alpha. All these basic things I should know before I should invest, because if you don't know the fundamentals of the company, definitely you will be in a trouble in the future days. That's why if the company's fundamentals are strong, definitely your share prices also will be strong. Okay, the fundamentals of the company is not that much good or average, your shares also will be tend to be average. So that's why we should understand the fundamentals of the company. So what you do in fundamental analysis, you check key metrics like price earning ratio. That is very, very important before you could invest in the shares. Or debt equity, how much debt the company has, what is the debt equity mix, EPS, earning per share, their profitability, profit, net profits, gross profit, and their different ratios like profit margin ratio, insolvency ratio, current ratio, profitability ratios. All these things I should understand before I could invest in the uh, company stock, and also analyze company's financial health. Okay, financial health means health of the company. The health should be very good, right? Excellent. If the health is excellent, definitely we do not have any fear. So financial health of the company should be excellent. So if you have the excellent health, excellent financial figures, then definitely you can go for investing in that company. Even the revenue growth here, we should make a trend analysis and see how the revenue has grown, because the basic income for any company is through revenue. Okay, if the revenues are raising year by year, that means the company is definitely doing a fantastic job. And also the profitability also should see the higher trend. The basic things before you should see the profitability. Revenue is very, very important for me, because that is the fundamental source of income for the company. Let's go for the fourth one, that is the risk tolerance. So what is risk tolerance? Yeah, stock market investment is definitely subject to risk, and stock market is volatile. You cannot expect the same trend every time. Trends will go up, trends come sometimes go down. It will typically go up, it will go drastically down. So you should understand the uh, risk tolerance level. So what is this risk tolerance level? Whether you are taking high risk or low risk or medium risk, that you should understand first. If you are taking a high risk, means you should have, I think you have backup of capital. You have sufficient capital with you. Even if something is lost, you have backup. And if you are taking a low risk, means I think everything, whatever the money that you have invested. Okay, that time definitely will take low risk. So that you should understand properly. Then always you should take a comfortable level of risk. It should not be too more, should not be too low also. So if you don't take risk at all, how can you expect profit, right? How can you expect growth in your income? So that's why you should take a comfortable level of risk which is tolerable to you. And fifth one is company profile. Very, very important. So company profile, in the sense, look at the company. When the company started, in which sector it is operating, what are the products that company has, what is the management level, whether they have efficient management. All these things have to be studied by the investors. Know that what company does. So what is the business that company is doing it? Whether it is doing a valid business or something or superficial, you should understand, because there are so many companies which are superficial. So first you have to understand what the company does. Then its competitive position. Okay, in the competition in level in the market. at what level the company's products are, that you should understand. Okay, if they are able to face the competition uh, well in the market, then definitely that company is good. And the future prospects, so what is the future uh, developments that company has, whether there is any future growth, that also you should analyze. And also look into the management. So management is the very important body which takes the company, okay, to maybe to the efficient position, higher position, or to inefficient position or lower position. Everything depends on the management. If the management is good, definitely you will earn better, you will earn more profit, your revenue will grow. So you should look into management. And also the products, the product line that company has, bundle of various products. And also the market share, this is also very important, whether the company has very low market share or higher market share. The company is consistently having a lower market share, that means company's future is not good. So all these things has to be analyzed, so many things to analyze before you could invest in the stock market. Then sixth one, stock performance and peer comparison. So how to compare the stock performance? So we have to just compare with another company. For example, if you take the IT sector, you take one Tata Consultancy Services (TCS) and you compare with Infosys, you will exactly know the comparison levels. Okay, comparison of stock of TCS and Infosys. So that you have to do, because uh, in industry there are so many companies, right? The same products they are producing, and there are so many companies which are operating and producing the same product, okay, or giving the same service. So you have to compare with the companies which are at the same product or giving the same service. So how they are doing it, okay, whether they are doing in equal performance with the present company where I am going to invest, or other companies are better than this company, or this company is better than other companies, that you have to make the comparisons. And also peer comparison. So peer comparison in the sense how other institutional investors are considering this particular company. Okay, so institutional investors, mainly the mutual funds and other institutional investors, how they have purchased the shares of this company, whether they are purchased heavily, whether they are purchased not purchased at all. So it depends. If they have purchased heavily, that means company has a very good growth potential. So through this we can identify whether my company share is giving me the sufficient growth and return in the future, whether my investment is a correct decision or wrong decision. Next, dividend history. Definitely everybody wants their shares to grow and get the regular income, right? So if you want regular income, then definitely dividend history has to be seen. So how much dividend the company is paying over the years, and how much you can expect in this year. So for this you have to go to the history of the company's dividend, and at that time you will come to know how the company has distributed dividends over the years. If the company has distributed consistent rate of dividend, that means this year also company is going to declare the same rate of dividend, and you can expect that rate of dividend, and that is a regular income for you along with the capital appreciation. And the next one is volatility and liquidity. So volatility, I think we have spoken many times about this word. So variations in the prices. Okay, variations in the prices. So volatility is inevitable. It is there in the stock market. So you have to accept that. And if you take more risk, then definitely more returns. If you don't take risk, then there will be less returns. So that's what volatility speaks about. High volatile stocks will offer you definitely big gains, but at the same time you should be ready for the big losses. So that is the principle of volatility, or accepting the risk level. And liquidity, what is liquidity? At any time if you are able to sell the shares, there should be buyer for your share. That means you can easily sell your shares, or you can easily buy your shares. So that is what liquidity. And the ninth one is diversification. So what is diversification? So there is one proverb: don't put all your eggs in one basket. So if the one basket has fallen down, all your eggs will broken. So the same logic has to be applied here. Don't put or don't invest only in one sector or one company. Distribute your investment in different companies, different sectors. So that time what happens, even if one particular company is not performing well, other companies definitely will be performing well. So your money is safe. Spread your investment to reduce the risk and improve the stability. This is how we have to spread our risk. So if one particular sector is going down, maybe other sectors are going up. So you see, you're safe here. So you are reducing the risk, and also you are getting the consistent returns. So that is very, very important in investing in stock market. And the last one is emotional discipline. So before investing in stock market, you should be emotionally disciplined. That means if somebody says, see, this particular company has given me 100% return, 200% return, 1000% returns, and what happens to us? So money means definitely we also want our money to grow like that, and definitely will be taken away by that emotions. Or maybe somebody has threatened you, don't invest in that market, don't invest in share market at all, your money will go. So that is also dangerous. So both things are dangerous. You should not be taken by any emotional blackmails. You should be emotionally balanced before investing. So avoid impulsive decisions based on market hype or fear. So don't take any decisions when you are emotionally weak. Should not take decisions. You should consult the experts or other colleagues or other friends before you could invest. Then stick to your plan and review it periodically. Okay, maybe you have particular set of plan that you have that you have planned by thoroughly understanding or thoroughly going through the analysis, and you have to restrict to that plan. You should not be taken away by other impulsive decisions or happens in the stock market, or maybe because you are provoked by somebody else. No, you should not do that. Okay, you should be emotionally strong, and whatever you have invested, you should stick to that. Okay, and follow the strategies. That's all. And these are the various factors that will affect definitely affect in investing in stock market, and we have to consider these factors seriously. And if you consider these factors seriously, and definitely your investment will become a fruitful investment. Thank you so much for watching this video.